Maybe there is a bit of luck and magic in success, but it's luck and magic that comes from working hard and being prepared. At the Rich Dad seminars, where I often speak, I see people all the time who are taking the first steps toward future success, much like I did nearly 2 decades ago. Many have what it takes, the drive and desire that will help them overcome obstacles and be prepared. Unfortunately, I also see at the seminars some who lack what it takes too. They are the ones looking to get rich quick and have little or no idea of the commitment required to achieve business success. Others have a lot of desire, but lack the technical skill and the knowledge that can only come from experience. I wrote this for them. This is not a get-rich-quick audiobook. Instead, it is a book that will disclose proven methods, remove the unknowns, and shorten the learning curve for anyone who chooses investment real estate as his or her path to financial freedom. Before we get too deep into the how-tos of finding, buying, and managing investment property, let's take some time to drive out a few myths. Myth number 1. You have to already be wealthy to invest in real estate. People think they need to have a large lump sum of money to invest in real estate. They think it is like saving for their first home, or that it is something that they can only do once they have made their fortune elsewhere. Both of these thoughts couldn't be further from the truth. You don't need hundreds of thousands of dollars in the bank to invest in real estate, and you certainly don't need millions. All you need is a good real estate deal that makes sense, one that has profit potential and is based on solid financials. My partner and I have been working this way for years. My very first investment deal was a condo that I bought furnished and then rented out. It was a 2-bedroom unit that I put into a rental program. People who wanted to get away from it all could call up and rent my condo or one of 100 others for a weekend getaway. A cool $116,000 was what I paid, and I put down $20,000 out of my own pocket. You're probably thinking, see, I knew you had to have some cash to get started in this business. Well, I did that deal before I knew better. Contrast that with a more recent acquisition of a 182-unit apartment community in Sun City, Arizona. The total cost was $9 million. Before you eject this CD and say, this is out of my league, let me finish the story. The down payment was $2 million, which we raised from other investors. My out-of-pocket was zip. I gave the majority of the ownership to the people who lent me the down payment and took 10% from myself. In essence, I formed a partnership with them. The deal was the hero. It was so good that people wanted to be part of it. What I've come to know is that there are a lot of people looking for good real estate deals. Today, my partner and I have people literally standing in line who want to invest in our next real estate venture. Not because we're anything special, but because we are thorough. We look at a lot of deals and choose only the ones that are financially viable. We also communicate with our investors and treat them fairly. They make money when we make money. Myth number 2. You need to start small. Big deals are too risky. There is nothing wrong with starting small. Perhaps you're thinking about buying a $250,000 single-family home and making it into a rental property, or even a $320,000 duplex. But why rule out a $2 million 50-unit building? Believe it or not, any of these properties are within your reach. Of course, right now you're thinking, no way, I can't afford a $2 million mortgage. And to that I say, you may be right, but you don't have to be able to afford it. Here's why. Mortgages on smaller properties, like single-family homes, are almost always guaranteed through the buyer's own personal earning potential and wealth. You may be surprised to learn that larger investment property loans are secured by the asset itself. In other words, instead of the $2 million building riding on your own wealth, it is riding on its own valuation. This is already less risk to you. Let's look at the previous example. The condo I purchased for $116,000 with a $20,000 out-of-pocket down payment was 100% my responsibility from mortgage to management. The $9 million project that I owned 10% of for no out-of-pocket cost was actually less risky because I had no cash invested and the property was professionally managed. The other property was mine, all mine, for better and for worse. 5 years later, I sold the condo for $121,000, a gain of $5,000. Recently, we refinanced the 182-unit building, which we had owned less than a year. Its newly appraised value was $11.3 million, more than $2 million above what we paid for it. And since I own 10% of the project, I made over $200,000 in less than a year. A testament to the power of buying and managing right and managing well. This example also demonstrates risk related to valuation. When you buy a house or a condo and rent it out, appreciation of the property rests solely on the appreciation of the surrounding neighborhood. By contrast, appreciation in a commercial property, like apartment buildings, is based on the cash flow of the property itself. The more money it makes, the more the property is worth. Now you're in control. Manage your property right, and you'll increase the value. Manage it wrong, and the value will stay the same or go down. Another way larger properties are less risky relates to occupancy. When a single-family home is rented, it's 100% occupied. When it is empty, it is 100% vacant, and you are covering the mortgage out of your pocket in its entirety. In a larger property, even an 8-unit building, if one resident leaves, you still have 7 residents paying rent. Your exposure related to occupancy is greatly reduced the more residents you have. Myth number 3, you can flip your way to success or get rich quick with no money down. Many people think that flipping property, in other words, buying it and quickly turning around and selling it for more than you paid for it, is the way to grow wealth. The people who believe strongly in this have been lucky enough to make money this way. But in my opinion, this is like day trading in the stock market. It isn't easy, and it is very risky. No money down is another way of saying that a property is 100% financed. In no money down deals, you'll be paying higher interest rates, have higher loan costs, and have virtually no money to improve the property or repair it should something break. With this model, you are banking on the property appreciating to make money, rather than improving the operations of the property and making money through increased cash flow. Let's hope the market is high-flying because you'll be banking on external factors being just right. Appreciation, as you'll see in great detail later, is only in your control when you've improved cash flow. As you might have guessed, I don't believe in $0 down, and I don't believe in flipping property. Even in the example where I personally put no cash down on the $9 million apartment building in Sun City, we as an investment team put $2 million down. I believe that buying and holding income-generating assets like rental properties is how you build wealth. You may say, but I need the capital gain, the additional equity I made on this property to buy a second bigger rental property with more units. That means I have to sell the first one. In my experience, this just isn't true. What you need is a second investment deal that makes sense that you can bring to investors. They will help you raise the down payment on the second property, and you will reward them as the investment makes money. We recently finished construction of a 208-unit property located in Goodyear, Arizona, which cost us $13.8 million to build. Upon completion, it appraised for $16.3 million. We have received numerous offers to sell this property, and brokers were standing in line for the listing. As tempting as it was to walk away after 2 years' work with $2.5 million in cash, we did not sell it. The problem is one of taxation. Had we taken the $2.5 million gain, we would have been forced to place that money back into the market to avoid a pretty hefty $750,000 tax payment. If you want the money out, you don't need to sell. You refinance the property and pull out what equity you can to put the money into another investment. In the case of the 208-unit property, we will refinance and we will use the equity that we pulled out of the property to pay back our investors with interest. It's a great system, and best of all, you still own the property. You continue to receive cash flow from the building in the form of rent, and as the building appreciates, you can refinance and take the gain tax-free again. Myth number 4. Some people just have the Midas touch. It is easy to think that people who are successful at investing in real estate have some sort of Midas touch, but there is no such thing. They are just people who see opportunities and know how to make them real and profitable. Take any 10-acre piece of land. Let's say this parcel is flanked by significant retail presence on all sides, and most of the big retail chains are represented in the adjacent centers. There is also a large microchip manufacturer nearby that employs 1,000 people. Ask a tract home builder and he'll see 40 single-family homes on that 10 acres. Ask a custom home builder and he'll see 10 luxury estates. Ask a retail commercial developer and she'll see a new shopping center anchored by 2 large retailers with specialty stores and restaurants as fill-in. Ask a multifamily developer and she'll see a 150-unit apartment community with a clubhouse, pool, and workout facility. Another commercial developer who specializes in office space may see a 3-story office building. In other words, everyone sees the property differently, and each vision will deliver a different level of payout, some better than others. The important part of recognizing opportunities is common sense. People who seem to have the Midas touch use their common sense when looking at property and opportunities. In the example here, common sense tells me that building custom homes would be a tough sell on a 10-acre parcel flanked by heavily trafficked retail. Single-family tract homes may be just as challenging. Additional retail may be viable if the developer can lure high-quality anchor tenants to the location, but they may already be operating in other nearby centers. By far, in this example, either multi-unit housing or office space are the most viable options. Why? Because of the nearby employment base, the absence of apartments in the area, the proximity to retail, and the lack of office rentals. The developer in this instance who builds offices or apartments will have the best chance of success and will appear to have the Midas touch. There's no magic, just common sense. Myth number 5. You need a great deal of confidence. Not true. People underestimate themselves all the time. They listen to that little voice of self-doubt telling them all the reasons they can't do something, why they shouldn't even try. I believe there are 2 voices, the voice of reason and the voice of self-doubt. The voice of reason is common sense. The voice of self-doubt is your past leading your future. I made a conscious decision not to let my past dictate my future. I grew up in an average middle-class home. I worked for what I got. I learned solid values from my parents. My father was not particularly entrepreneurial until later in his career. Hardworking, yes, but not entrepreneurial. He worked for the same company for most of his career. When I got out of college, I followed in my dad's footsteps and got a job. But while in that job, I began to meet people who showed me their entrepreneurial ways. They became my mentors, and from them I became entrepreneurial. Then I combined the innate values I received from my parents and my own newfound entrepreneurial spirit, and I became whole. Nothing in my upbringing would have prepared me for what I'm doing now, and yet everything did. I believe it is up to each of us to let go of the memories of unsupportive fathers, ultra-critical mothers, ridiculing friends, and teachers who labeled us from the first day of school. Everybody has had negative influences in their lives, and everyone must rise from challenging situations. That's what successful people do. Myth number 6. You want to do it, but don't really have the time. This really comes down to choices and priorities. There is always time to do the things we need to do, like go to work every day, mow the lawn, feed the dog. Often there isn't time to do the things we really want to do. Learn to speak a second language, or volunteer in the community. We'll often do what we need and put off what we want. Unfortunately, our wants are what truly enrich our lives. The investment real estate business is something you should want to do and may even need to do. It's work. To be truly successful, especially in the beginning, you will be involved in the day-to-day activities of finding and evaluating property, negotiating deals, overseeing contract repair work, possibly even managing the property once it's yours. I can honestly say I find the business rewarding, fun, and because of that, it is profitable. Myth number 7. You have to know somebody to get going in this business. While knowing a few key people such as a real estate agent, an attorney, or a banker may save you time, you don't need to know anyone even remotely connected with investment real estate to get started. Just get started and you'll be surprised at how many people you'll get to know and how much they'll teach you. Here's an example of what I mean. My company became interested in the real estate market in Portland, Oregon a few years back. We knew that the city was situated on two rivers and that unemployment was high. The latter meant that the people who owned property in Portland were probably not doing so well, and to me that spelled buying opportunity. We had one big problem. We knew about the city, but we didn't know a single person in the city. I live and work in Arizona. Neither I nor anyone else in my company knew a soul in Portland, but we figured the market conditions were at least worth a plane trip and a few days in Portland. Before our trip, we made our minds up to find our team, or at least the start of it. We went on the internet and looked up property managers, city officials, brokers, etc. We were not about to travel that far and not meet with anyone who could educate us about the market. As a result, we had 10 or 12 meetings over a period of 2 days. It cost us a few lunches and dinners, but we had the beginnings of our team. I'll tell you more about our experiences in Portland a little later in the program. Myth number 8. You have to be a seasoned negotiator and business person. Again, this is just not true. Experience in business may make that first walk into an investor's office more comfortable, but that's all it will do. Your true power and confidence won't come from your past experience. Instead, it will come from the solid deal you assemble that is a win-win for everyone involved. This audiobook will show you how to find and evaluate property, with the ultimate goal of establishing a realistic purchase price that maximizes your monthly income and appreciates the asset. Find a deal like that, and everyone will want a piece of the action. Over the years, I've walked away from a lot of deals, and negotiation had nothing to do with it. One of those deals was a 205-unit building in Glendale, Arizona. About a year ago, the listing price was $7.9 million, and the broker told me that there were other offers. We did our homework on the property, and by my estimation, $7.2 million was fair based on the operations of the property. The seller declined every offer and pulled the listing. 6 months later, the seller relisted the building for $8.1 million. If I had still been interested in the property, I would have made an offer based on operations. It would have been the same $7.2 million offer I made before. The seller would probably kick me out along with everyone else who made him an offer based on his operations. Are you surprised to learn that he still owns the building today? With the methods you'll learn from this program, you'll find out that the listing price is meaningless. There is no point negotiating based on this number, and actually doing so is a recipe for disaster. That's because in most cases, the listing price is the seller's opinion of what the property is worth. It is not founded on the actual operations of the property. What most people consider negotiation meetings are, for me, more accurately described as presentation meetings. That's when I present the numbers I've calculated, and they are pretty much take-it-or-leave-it deals. When I get kicked out, and in truth, usually it is a mutual parting of the ways, it's because the numbers don't work. Walking away is a good thing. Myth number 9. You have to know a lot about real estate. This myth holds people back every single day. They feel they have to already be experts in a field in order to be successful, whether it is real estate or stock investing or dry cleaning. First of all, success is a journey. It is not a destination, and all successful people start at the same place. One day they wake up, they throw their legs over the side of the bed, they yawn, and they begin. Only by continuing day after day do we ever become experts. We gain expertise through experience. By listening to this audiobook, you'll get a solid framework from which to begin, but you'll learn tons more from your first deal, and more still from your second and third. Myth number 10. You can't be afraid of failing. Show me an entrepreneur who says he or she isn't afraid of failing, and I'll show you a liar. Everyone is afraid of failing. The difference is that some of us let that fear stop us from beginning altogether, and that's unfortunate. If that's the case, make the decision now to just begin putting one foot in front of the other, making one phone call at a time, visiting one property and then another. It's not hard, but it can seem so if we focus on the end result instead of the tiny steps in between. Sometimes fear of failure occurs when it comes time to pull the trigger on a property. I call it analysis paralysis, and people fall into it all the time. They overanalyze an opportunity and are never quite able to sign on the dotted line. This audiobook will prove especially helpful to people with this sort of fear because it will show you exactly what you need to know to analyze an investment property. When the numbers add up, no further analysis is necessary. Frozen in fear will be a thing of the past. Myth number 11. You have to know the tricks of the trade. There are no tricks of the trade in the purest sense of the term, but there are secrets to success in life. And as long as you know those, you'll be successful at anything. First, you have to set goals. Goals will be the foundation of the roadmap for your success. Second, you have to persevere. Quitting when things get tough doesn't produce winners. In 15 years, I could have quit 100 times. I've had plenty of tough problems. Financing that falls through, employee problems, and downright frightening resident issues. But successful people work through difficulties and they come out on the other side, stronger, more confident, and better prepared for the next challenge. Finally, you have to understand the process. That's what this audiobook will teach you. It will take you from beginning to end and every step in between. From setting goals to setting up your team, to finding property to evaluating it, to determining a purchase price to managing the property, I'll let you in on 15 years worth of experience. You gotta have a goal. The title of this section spells out pretty clearly how I feel about goals and real estate investment. Having a goal is not optional. Goal setting is step number 1 in the process. In this section, you'll learn what a realistic goal should look like and how you can achieve it. When I first started out, I had a goal. I wanted to be my own boss. I was tired of working for someone else and wanted to start some sort of business on my own. Admittedly, I never actually wrote down my goal in those early days, and I didn't tell too many people either. In fact, I barely verbalized it to myself. More accurately, I felt it. It wasn't until years later that I really understood goal power. The power you feel when you've set a target and you concentrate all your efforts on hitting it. It makes you focused. It makes you decisive. And ultimately, it makes you successful. I don't know if anyone else before me has used the term goal power. It just seemed to accurately communicate a fact that's important right now, that having a goal makes you powerful. What is a goal? It's easy to get hung up on terminology. Is that a goal? Is it a vision? Maybe it's an objective. Maybe it's a mission. Forget all that right now, and don't worry about textbook definitions. My goal with this audiobook is for it to become the best-selling guide that simplifies the process of real estate investing by showing you how to find, buy, and manage property right. And I may as well start with goal setting. A goal is something you plan to achieve. Simply stated, a goal is something you plan to achieve. Maybe your goal is to buy one investment property in a 12-month period. Or maybe you want to earn $5,000 a month in income within 2 years. You might even set your goal so high that you decide you want to be the #1 rental property owner in your town within 5 years. Whatever goal you set, make sure it is something you plan to achieve. Nothing is more valueless than a goal that sits on a shelf and never receives any action. Those are simply dreams. And there is no real power in dreams unless they are acted upon. Your goal should be measurable. My original goal of wanting to be my own boss wasn't really a good goal. A much better goal for me would have included a time limit, say within 1 year, to become my own boss. Or an earnings level, like earning $75,000 per year. Goals that are vague are hard to attain and are even harder to stick to. If there is no time limit, dollar amount, or rank comparison, how will you know when you have arrived? It is virtually impossible. One real estate investor I know has a very measurable goal: to acquire 1 2-unit property per year. Another has a goal of acquiring 10 homes a year. The point here is that the goals are achievable and measurable. What will your goal be? Your goal should be attainable. Goals must be realistic and attainable. Otherwise, they will either be shelved and never acted upon or modified midstream to something more realistic. The latter alternative is acceptable, but goals that are set too high can trigger feelings of failure if not attained. Setting your goal. Goal setting requires you to be honest with yourself and reflect on what you really want in life. That means taking the time to think about what you want for yourself and your family right now, in the years ahead, and long into the future. Your goal may evolve over time. After a few years of working for myself as one of the 2 principal owners in Arizona-based MC Companies, the property management firm my partner and I still own today, I began to discover that my goal had evolved. I wanted to be more than just my own boss. I realized that I wanted financial freedom. Freedom to do the things in life I wanted to do, like spend time with my children, coach Little League, and travel with my family. I knew this goal could only be attained through the accumulation of wealth. So my partner and I, in addition to managing properties, began investing in them as well. Today, I have a measurable goal related to financial freedom. I'm not there yet, but I am working on it. It takes a team. Everyone has a team. Even the Lone Ranger had Tonto and Silver. Well, in the business of investment real estate, you can't afford to be a Lone Ranger. In fact, it's impossible to accomplish your goal on your own, no matter what your goal is. Why have a team? Having a team of experts on call is not free and it is not cheap. Those are the 2 biggest reasons why many inexperienced investors make a rookie mistake. They try to do almost everything themselves. Sure, they may save a few dollars in the short run, but they usually lose in the long run. Without experts on your team, deals take longer to find, evaluate, and close, so there's a value of your time and the loss of valuable opportunities. Do-it-yourselfers miss details that experts would see in a minute, like clauses missing in contracts, obvious defects in construction, and hundreds if not thousands of other issues experts would point out up front. Real-world case. One investor who decided to go it alone is a man from Seattle who called us right after he purchased a 100-unit property and asked us to help him manage it. The key word here is after. The property is in Phoenix, and he had absolutely no plan for it. He had never walked into any of the units. He never called anyone to inquire what the resident mix was like. He never even checked what kind of neighborhood the property was in. He had bought it sight unseen. The property was in massive disrepair, a nice way of saying it should have been condemned. And worse than that, it was full of gang members. Even the Phoenix Police Department was instructed never to enter the premises without backup. This man's laziness on the front end cost him tons of money. I wonder why now, but we did take on the management contract for this property, and the price tag was pretty steep to get this place back in shape. Outside contractors of every kind, lawyers, you name it, we hired them all. We sent eviction notices that nearly evacuated the entire place just to get rid of the riffraff. That meant the owner endured months of significantly reduced income and sky-high marketing costs to get the property leased. It was a mess that took the better part of a year. If this man had taken the time to establish a network of people in Phoenix before buying the property, they would have either steered him clear of the property or flushed out all the issues so he could have established a plan to turn the property around. This is just one example. There are thousands of others. The point here is simply that the wise investor pays on the front end and reaps the rewards on the back end. The fees it would have cost the property owner from Seattle to have his Phoenix team visit the property and file a report or two were a pittance when compared with what it cost him to get his property in shape. My brother-in-law is an accountant. People have wildly different views on partnering with family members. Some say go for it and save a bundle. Others say avoid it at all costs. I fall somewhere in between. I believe that having family members on your team, or even partnering with them, is a good idea as long as you make an informed decision and know what you are getting into. Because, let's face it, next year's Thanksgiving dinner is on the line. Plenty of families can mix business with personal relationships and do just fine. Others have not mastered the art. Only you know where your family fits in. Partners. A good thing or a bad idea? At MC Companies, my partner Ross and I have been together since almost day one. His skills and my skills dovetail perfectly. He handles the construction and development, and I handle the management and operations. We both handle acquisitions, and together we each bring to the deal our own unique perspectives. It's a great relationship, and because we have mutual respect and honesty, it works. Here are some qualities good partnerships have in common. Healthy debate. You should have room for debate before decisions are made. Open-mindedness. You shouldn't have to spend valuable time continually convincing your partner of your goals. Commitment. You should be committed to each other and your goals. Similar values. You and your partner should share the same values. Accountability. You and your partner should push each other to achieve objectives and have mutual accountability. These qualities will guide you in establishing a partnership in your business. Now we'll look at how to partner with others outside your company. Your all-important team. The following lists include all the people and professionals you will eventually have in your team and how to evaluate and select them. While the lists may appear overwhelming, understand that you will accumulate contacts over time and you don't need all of them at all times. There's no need to run out and start interviewing paving companies, for example, when you don't have a parking lot that needs resurfacing. You just need a few key team members to get started. An attorney, an accountant, a real estate broker, and a property manager. But here are the full lists to get you prepared. Your business team. Before you do anything, even print your business cards and letterhead. Get your business set up correctly. To do that, you'll need to talk to an attorney who will advise you about setting up your company. Should you set up a corporation, a limited liability company, or some other business entity? Regardless of which you choose, having a formal company established will protect your personal assets and provide tax advantages to you. The property search team. The property search team will primarily consist of a real estate broker and a property manager. I recommend interviewing several professionals in each field until you find people you like, who know the market, have your same level of integrity, and who understand that they are there to help you achieve your goal. Both of these professionals can also help you establish the rest of your team, especially for the property inspections process commonly called due diligence, which occurs once you get into escrow. The offer team. Your property search team will most likely refer some or all of these professionals to you as you need them. That's another reason why your real estate broker and property manager are so critical. They set the tone for your entire team and therefore your entire work experience. Choose wisely. Attorney. Your attorney will certainly help you set up your business, but he or she will also help you wade through letters of intent and purchase and sale agreements. Lender or mortgage broker. Find a lender or broker who understands the business of property investing. Not only will they lend you money, but they will also provide you with leads on other properties that are ripe for sale. Investors. By communicating your goals and doing the work of building your team, you should find several sources of equity who will entertain investing in rental property. Contractor rehab specialist. Contractors see things that you and I don't when it comes to walking a property. Before I sign any deal, I have a contractor perform a detailed inspection and file a report of all critical and non-critical repairs. Other team members. From time to time, you may find you need these professionals to assist with projects that arise when either considering a property or once you own it. As with the professionals on the previous list, these team members will come to you through referral. Accountant. Your accountant will help you not only with your own business finances, but also help you put together profit and loss projections for the properties you are considering. Appraiser. An appraiser is an important team member and should be a person who specializes in both your market and the types of properties you are targeting. This professional will help you determine the appraised value of a property before and after the sale. Architect. Some properties need more than just a coat of paint and the bushes trimmed to get them into shape. An architect can help you with new design ideas and renovations to increase curb appeal and operations performance. Insurance agent. The insurance agent will help you place the proper protections when you own the property. Having the right coverage for the right price will be necessary if you acquire the property. Property tax consultant. Property taxes are realities in this business, and property tax consultants can ensure that your taxes are being assessed fairly and accurately. Income tax consultant. The tax laws are complicated, and it is always good to have the advice of someone whose job it is to keep up with tax law. Estate planner. As your real estate assets grow, an estate planner can help you shelter and dispose of them in the event of illness or death. Environmental company industrial hygienist. If you suspect mold, asbestos, or any other environmental hazard, you'll need one of these to help you through the process of testing and removal if necessary. Surveyor. As you are rehabilitating a property, you may need the services of a surveyor to assess boundary lines, elevations, and other such matters. Structural engineer. Your construction rehab professional may find a problem that jeopardizes the structural integrity of the building. Call in a structural engineer who will analyze the problem and recommend a strategy to repair the building. Teams are just that, people who work together to get the job done. They should be on your side and have the mentality that when you are successful, they are successful. Keep searching until you find people whose goals and business methods gel with your own. Research can be fun. At Robert Kiyosaki's Rich Dad seminars, where I often speak, attendees always ask me, how do I find a good investment property? This has to be the most commonly asked question, and for good reason. There is a needle in the haystack sort of quality to this whole endeavor, or at least it seems that way, particularly if you've never done it before. Do you look in a newspaper, grab sales sheets from real estate offices, check out the internet, drive around? The whole thing seems so haphazard. Truth be told, there is a lot of information out there about property and a lot of ways to get that information. Maybe too many ways. Knowing which resources are valuable and knowing how to access them can save you time and frustration. In this section, I'll reveal a research strategy that you simply cannot do without. By walking you through my experience of buying a property in a new market I knew nothing about, you'll see how this research method works and what you can gain from it. Researching a market can be a lot like doing the preliminary research for a college paper. Maybe you remember the feeling of stepping into the library for the first time. Looking around at all the books, magazines, computer databases, and microfilm, if you're as old as me, was overwhelming. You knew the information you were looking for was in there somewhere. The problem was finding it and making sense out of it. Your first paper was always the hardest, but once you got familiar with the best sources in the library, the next papers got easier and easier. Well, at least that's what I was told. But my college professors would be proud of me today because I did eventually learn how to do research, and I learned how to make it really fun. We have a great time researching markets and properties because research to me is nothing more than using the resources around you to gain information and insight into a particular subject. In this business, that means talking to people, touring an area, taking in the sights, even within your own town. Kind of sounds like a purposeful tax-deductible vacation, doesn't it? Well, it can be. So let's get the party started. The research techniques described in this section will help you three ways. First, they will give you a snapshot of the various markets and submarkets within your city or town. The more diligent you are about doing the research, the more vivid the picture will be. And in the sections ahead, you'll see why a very vivid picture here will save you time and money later. Second, this research will show you how the market will influence your property investment. And third, you actually may be lucky enough to find property leads during the research phase, but don't count on it. The most important fruit from your efforts is the picture of the market. The properties will come later. I grouped the research I do into three categories. The descriptions for each are in the sections that follow. Level 1 research. Level 1 research is what I call the very preliminary stuff. To do it, you don't even have to leave your house. This is research you do before you even set foot on a property, or in the case of the true story of our acquisition of waterfront property in Portland, Oregon, before we even stepped foot in the town. You should know we didn't just pick Portland out of a hat. Before we settled on Portland, our goal was to do level 1 research on all the major markets in the western United States. It was time to expand our company's reach, and the question was, where to go? One of the first things we did was look at all the newspapers and business journal newspapers in every major western city via the internet. We followed the online hyperlinks to every interesting lead. For example, we'd type in a city like Denver into a search engine, and up would pop a story about population growth. We'd follow it. Then, as part of that story, there'd be a link about school funding. We'd follow it. What we found was very interesting, particularly in Portland. First, we discovered that the city has an urban growth boundary that we felt would limit the supply of rental property in the future. That's a good thing. Next, we found that the city of Portland was progressive in their downtown planning and progressive in terms of transportation with their light rail, bus system, taxi system, streetcar system, and even plans for a future water taxi on the Willamette River. We also found that living and working downtown was in high demand and that the downtown employment picture was favorable. We were beginning to get our picture of the market, and it was looking good. Then we started to uncover some of the city's limitations. On the downside, we found statewide unemployment was leading the country with a whopping 8.1%. This was an important finding because when we saw that statewide number compared to unemployment in downtown Portland, we knew for us the only opportunity was downtown or possibly a few other suburban bright spots. Furthermore, downtown was mostly all built out and had even greater supply restrictions than the rest of the metro area. Our job was not going to be easy. We found out this information in less than a day, all from my desk in Phoenix, Arizona. Although there were some negatives about the market, overall, we were pleasantly surprised and impressed with downtown Portland. It had good employment, was progressive, had a very high cost of home ownership, and was in high demand. This was all good news for rental property investment. We knew it was worthy of a site visit. Level 2 research. In Portland, we were a couple of desert dwellers from Arizona who came armed with information but hadn't seen rain in months, let alone trees that actually bear leaves. We were as green as the Portland landscape. We plunked right into this market knowing no one. We were prepared, however, to conduct level 2 research once we got there, to develop a team that would help us understand the market and maybe even lead us to property. Research plays an important role in establishing yourself within a market and finding the people who will help you make things happen. Level 2 research is about meeting face-to-face, and we didn't waste time. Even before we arrived, we had made phone calls to set up meetings with property managers, commercial brokers, commercial lenders, city officials, and business people like the publisher of the local apartment guide. When we arrived, we met with each of them. First of all, they were amazed at how much we knew about the area and the depth of our knowledge. They affirmed the things we presumed to be true and set us straight on the assumptions that were off base. For instance, They confirmed our assumption that the limited supply of housing in downtown Portland was greater than in any other area of the city. They confirmed that there was a high demand to live and work in the city. They confirmed that the downtown area was not only a vibrant, progressive community for those who live there, but that it was also a draw for people who lived elsewhere through its Saturday markets, jazz festivals, holiday events, convention center, rose garden, parades, and more. It was truly a city center. We didn't get everything right during our Level 1 research, though. The people we met with surprised us by painting a gloomier picture of the outlying suburban areas than we had painted ourselves. There was more overbuilding than we had assumed, and there was more available land than we had assumed. Nike and Intel had a very large presence there without much other employment of any size. The overall picture was clearly a risky one. It was during this time that we really started narrowing in on our submarket. In any economic downturn, it's always smart to be in the market that will turn positive first. That's true of anything in business, whether it's the stock market, a business sector, or real estate. So we looked at several submarkets and determined that downtown Portland was the strongest at this point and would be the first to rebound based on the simple economics of supply and demand, its diversified employment base, and lack of affordable housing. We learned that as the economy rebounded, the downtown market would be the area that rebounded first. While we were meeting with all our contacts, we clearly communicated our goal to buy a 200-plus unit apartment community and asked them a variety of questions like who their favorite property management people were, what lawyer they recommended for legal work, if they knew of any good accountants. We asked for recommendations for every team member we listed in the last section. By the time we left 2 days later, we had a vivid picture of the market, and we had narrowed our search to a viable submarket. We had some good leads for our team, and we were told of several properties that were possibilities. We also took in the sights, ate wonderful dinners, and generally enjoyed our time in Portland. Level 3 research. When we returned to Arizona, we not only vividly remembered what green trees looked like, we knew Portland was an investment opportunity, but we still needed a bit more information to feel good about making a move there. That's where Level 3 research came into play. We first called every team referral and asked them all the same questions we asked of all our initial contacts in Portland. Not only did they give us their opinion and insights, they pointed us in the direction of numerous websites, analyst newsletters, economic development offices, city government contacts, and other Portland business people who could add the finishing touches to our picture of Portland and could keep us on top of happenings in the area for as long as necessary. Through this exercise, we started to discover who should be on our team. We signed up for free online newsletters, got on the mailing lists and email lists of real estate agents, commercial brokers, loan officers, and other professionals helpful to us. We are forever in the know and hooked into the network. No longer do we have to seek out all the information, as a lot of it now comes automatically to us. During this whole process, we felt like detectives, following up on leads and putting the evidence together to arrive at a conclusion. By involving others, we were able to maintain our objectivity and keep our perspective. All this took was some time on our part. The biggest out-of-pocket costs were our economy seats on Alaska Airlines and one night at the Fifth Avenue Suites. We're talking shoestring. And best of all, we paid nothing for the information we received during the process. On top of it all, it was a good time. Why wouldn't you do this? Ultimately, our vision of an apartment community evolved into a condominium conversion project. The research we did took our vision of an ordinary project and made it extraordinary. We were able to redevelop an area, deliver exactly what the area needed, and give the city and the people what they wanted. I don't buy anything without researching the market first. Even in Phoenix, which is a market I know extremely well, I do research before I buy anything. Things change. Markets and submarkets go in and out of favor. Big projects like highways change the patterns and flow of a city. There is always something. Today, thanks to the internet, research is easy and takes virtually no time. For as difficult as researching that first college term paper was, this is a breeze. And there's never been more writing on getting an A. Swampland for sale. Next time you drive to work, take your son or your daughter to school, or race down the highway you've traveled hundreds of times, look to the right and the left. What I am trying to say is this. Take the time to really look around. I travel roads, the same ones every day, just like you do. I think I know the area. You probably think you do too. After all, you pass by the same houses, the same stores, the same apartment buildings, the same office parks every day, right? Well, caution here. This type of complacent knowledge, the knowledge you get by passing by, can be dangerous when it comes to property investing. First impressions and outward appearances of cities or towns and the neighborhoods within them, also called markets and submarkets, can be deceiving. So can buying anything in a market that you know nothing about. You've heard the saying, and it's true. A lot of swampland gets sold to unsuspecting buyers, not just in Florida, but in every city and town across America. Every town has its swampland. You know, it's the investment that sucks up all your resources and offers nothing in return. And let's face it, getting people to venture into the murky water is a lot more challenging with alligators lurking around. If we learn anything from all those poor people who have purchased swampland with the hopes of striking it rich, we should take away one lesson. The market is more important than the property. I am always amazed by how much there is to know about a specific market or even a small submarket just a few blocks in size. What you see on the surface is just the beginning. And just when I think I know an area really well, something changes. In this section, I'll show you how to get beyond the appearances, avoid the swamps, and see the true picture of a market and its smaller submarkets. And in the process, you'll gain objectivity, a very good thing indeed when it comes to real estate investing. The problem with gut feelings. Too many people purchase investment real estate on a hunch or a gut feeling. And while it is important to have instincts, understand that they are the products of experience, not a right of birth. People are not born knowing this stuff. I believe it is impossible for a person who has never done a single investment deal to have an instinctive knowledge that one deal will be better than another. It's not that simple. In fact, that's the kind of naive thinking that gets investors off to the wrong start. Save your gut instincts for 20 years down the road. Starting off on the right foot involves doing one thing really well: evaluating your market and submarket. You must get to know your target area and become an expert in it, not for the sake of merely becoming an expert, but for the ultimate purpose of finding a great property investment that is viable and profitable for the long term. That's what we're shooting for here. If you can accomplish that, the rest becomes easy. I've been in business for a long time, and even I don't rely on instincts alone. Before we invested in the Portland River District, we did our homework. Through our online research, our site visit, our meetings during our 2-day tour, and our follow-up phone calls. That was covered in the last section. To be honest, we had no choice. Knowing everything about the Portland market and the submarket of the River District was the only way for me to make realistic projections about future profitability. It was the only way I could feel comfortable about making an investment. Knowing the market inside and out was the key to knowing if the project would be viable. Fact-finding is the opposite of relying on gut feelings. In the last section, as I discussed my research method, I touched on a few important concepts that are worth defining further. These concepts are critical to understanding the total picture of the market and submarket. Supply and demand. When it comes to investing in property of any kind, I make sure my first objective is to get an accurate read on the supply and demand in the area. I'm not talking anything complicated, just basic economics. Supply is defined as the number of rental properties available in a market or submarket. Ideally, supply should be low and demand should be high. Supply is easy to determine. In Portland, we asked our research team, specifically brokers and property managers. They had detailed data, including property names, sizes, addresses, and dates of construction. Seek out this help. Why do all this work on your own? Demand, on the other hand, is a bit trickier. Demand is defined as the number of people looking to rent. I estimate demand based on occupancy rates in the area. If a submarket has high occupancy, demand is great. If occupancy is low, demand is soft. Another indicator of demand is the prevalence of move-in incentives and specials. If there are a lot of move-in specials advertised, demand is low. If rental properties are offering no incentives at all, demand is high. Another factor to consider when determining supply and demand is future supply. By future supply, I mean any and all new rental property that is in various stages of development, from planning to permitting to construction. Future supply is a critical indicator of how properties in the area will perform long-term. If through your research you find that supply is greater than demand, you may want to stay away or at least keep looking for a better market. Your job of finding residents, generating cash flow, and increasing the profitability of the property will become more difficult. And remember, the value of a rental property increases based on its operations and cash flow. In Portland, demand in the submarket we chose for our waterfront project certainly exceeded the existing supply. We knew that based on our face-to-face meetings and the fact that nothing was available in the area to rent. But by contrast, in the small mountain community of Fountain Hills, Arizona, the opposite is true. Here, rental properties, including large apartment communities, and uncountable numbers of duplexes, condos, and single-family homes seem to be everywhere. Many were purchased by hopeful investors, and now they are competing head-on for a relatively small number of renters. The reasons for this lopsided market state are no mystery. Rather, they are totally explainable. Have you figured them out yet? The three drivers of supply and demand. Simply, there are three drivers of a market's or submarket's economics that come into play. As an investor in real estate, you'll want to keep each of these variables in the forefront at all times. They are true indicators of supply and demand. Employment. This is the first and possibly most important indicator of demand, and for good reason. If a market or submarket has lots of jobs, people will come to fill those jobs. Very basic stuff. It is a fact that jobs drive residency. So with all things being equal, property that is near to employment is in greater demand. That's not to say that people won't drive to live in a highly desirable city or town or that people won't drive to their job, but just be aware of the market condition. When you're looking for indicators of supply and demand, look at employment. In the case of Fountain Hills, Arizona, there is little to no employment base at all. Nearly everyone who lives in the town who is of working age works elsewhere, like in neighboring Scottsdale. Scottsdale, by contrast, has many employers. Both Fountain Hills and Scottsdale are desirable places to live, and both communities are beautiful places with excellent qualities of life. But Scottsdale wins in terms of employment and therefore in terms of demand. People have to really want to live in Fountain Hills, and many do. But the lack of a large employer or large office complex that brings workers to the town means that Fountain Hills will find it difficult to balance the supply and demand for rental properties for many years to come. This same theory is also true for the town's retail businesses and restaurants. Employment opportunities bring customers. The saying that people go where the jobs are is true. It's what attracted people to Houston, Texas in the late 70s and early 80s, and it's what has been attracting people to Phoenix, Arizona for the last 20 years or so. Create jobs and people will come. High employment can be beneficial for rental property investments, but be sure to look at the whole picture. Even communities with lots of jobs can still be overbuilt, thus throwing off the delicate balance of supply and demand. Scottsdale has been smart to limit the supply of rental properties. That has helped keep the vacancies low and the rents high. Fountain Hills, with its plentiful land by contrast, allowed the construction of too many rental units, and therefore vacancies are higher and rents are lower. Fountain Hills could have been a premium rental community even without a strong employment base, and once was before a boom in rental properties occurred in the mid to late 90s. Employment stability is also something to consider. As you evaluate your market and submarket for employment, look at how stable the employment base is. Are the companies reputable? Are their products or services in ever-growing demand? Is the mix of companies diversified? These are indicators of stability. Just look at Houston in the 1980s. Rental properties were booming, and then the oil industry came crashing down, taking with it banks, hotels, home building companies, and numerous other businesses. Apartments were vacant all over town, so to lure renters, owners and property managers were offering ridiculous move-in packages, including 6 months free rent, free televisions, and no security deposits. A significant drop in the local employment had a significant impact on the economy. Population. In a world of choices, choose to have your first, well, let's face it, all of your investment rental property where the people are. We've already established that you need a stable and growing employment base, so it makes sense that you'd also want to be in an area where there are lots of people. People who are your future customers. That may be a bit cut and dried for the new investor who's thinking about taking advantage of a great deal on a single-family home on the outskirts of town off the beaten path. While it may be a wonderful property and seem like a great deal, that's meaningless if nobody is around to lease it. People certainly go where the jobs are, but they also migrate to places that have a certain persona or living experience built into the area. That's a somewhat vague concept, I know, so it may be best to use examples rather than try to explain it. If you've ever been to Venice Beach in California, you know that it's a submarket of Los Angeles that has a definite persona or living experience. First of all, it's a California beach town that conjures up all the fun and freedom that the California Office of Tourism, Hollywood, and the Beach Boys spent decades promoting through commercials, movies, and songs. Next, it's a submarket even among other beach towns that has a reputation for being edgy, avant-garde, and youthful. Purchase investment property in Venice Beach and you wouldn't have to say much more. Lots of people are drawn to this lifestyle and the persona of what living in Venice Beach means. Contrast that with the Phoenix submarket of Dobson Ranch. There are rental properties in this master plan community, but the area has no real persona that drives the multitudes to it. Sure, it's a nice place to live, and a great place for families, but there is no major image that draws population. I'm sure that most everyone listening to this audiobook has never even heard of it. Other areas that come to mind when I think of living experience and persona are Key West, Florida, and Coronado Island, California. Aspen, Colorado is the place to ski and be seen. And finally, Scottsdale, Arizona is known for sun, golf, spas, and shopping. These are famous places that possess persona, but there are other less famous areas in every community that have unique persona and living experiences that are known to those who live in the region. Remember, places that have defined persona clearly are population draws almost as powerfully as employment. The lure of charming buildings in towns that lack employment and a solid persona have tempted even the best of us, me included. But don't get caught. Unless you're a Vegas gambler who always tries to beat the odds, stay away from markets and submarkets that are not drawing people. Now that you know some of the reasons why markets attract people, you'll need to know how to quantify the population in your area. Talk to your team members, city or town officials, visit their websites and set up meetings. Remember, as a taxpayer, you are paying their salaries. You are their customer. Do whatever it takes to get realistic population projections. And when they rattle off blue sky numbers, ask them to elaborate on the factors they see that are contributing to this optimistic growth scenario. If any of your sources project population to decline, that's a bad sign, but at least they're honest. I always look for real indicators from people, not blue sky, and value them for telling it like it is. In addition to employment and town persona as population draws, your context may also refer to the following. New highways or highway extensions. These create new traffic patterns and transform areas that once seemed a long distance away into places that suddenly seem close by. If a new highway project is slated near that single-family home off the beaten path we talked about earlier, it may not be such a bad investment opportunity after all. Master-planned communities. These large residential projects combine home and work and with them draw lots of people. New communities in particular are usually backed by big dollar advertising campaigns, and the older ones like Dobson Ranch mentioned earlier become yesterday's news. New sports stadiums and arenas. So often the hub of urban redevelopment is a sports stadium or arena complex. These facilities bring tens of thousands of people to an area and open up all kinds of opportunities for investment real estate. Universities and university expansion. Universities are always population drivers because, just by the nature of what they do, they bring a steady stream of students, faculty, and supporting businesses to an area. Redevelopment areas. Our project in Portland is an excellent example of a redevelopment area. The ideal central locations, community goodwill, and an aura of coolness often associated with redevelopment makes these kinds of projects population magnets. People love the wow factor associated with before and after stories. Casinos. Casinos bring with them the masses who every weekend and a lot of weeknights want to try their luck and win big bucks. They say that in the gold rush of 1849, the people who made money were the ones who housed the miners and sold them goods. Military bases. Not all military personnel live on the base. The property around government installations is often a good investment. Just be careful of base closings, which are often in the news around government budget time. Regional airports. Scottsdale Airport is a prime example of how valuable real estate can be around airports. The Scottsdale Air Park is a haven for small businesses and a real driver of rental communities and single-family homes in the area. Company relocations. When Boeing moved from Seattle to Chicago, with it went thousands of jobs. Bad for Seattle, great for Chicago. Corporate relocations are instant population boosters. Major events. The 1962 World's Fair redeveloped downtown Seattle, and the legacy of that event, of course, is the Space Needle, which is still a tourist attraction over 40 years later. Olympic Games also have a way of transforming communities, as the 1996 Games did in Atlanta and the 2000 Games did in Salt Lake City. Even annual events like the Super Bowl can completely revitalize an area through huge injections of new money. These are just a few population drivers, and when you see, hear, or read about them, they are good indicators for growth. Projects and developments such as these tend to reshape the face of a community, and change of this type is potentially lucrative for real estate investors. But there are also a few things to watch out for. Economic diversity. I steer clear of areas that don't have a good, diverse economy. It's happened before, and it will happen again, that an entire market falls victim to an industry sector that goes bust. It happened in Pittsburgh, Houston, it happened in Detroit, and most recently in the San Francisco Bay Area when the dot-com bubble burst. Affordability. I always look at the affordability of housing in a particular market. If a single-family home is out of reach for most people, apartment living becomes a valuable option. This is the case in big cities like New York and San Francisco, which attract large populations, most of whom cannot afford homes. Look for markets where the cost of home ownership far exceeds the cost of renting. The closer the two variables are to each other, the harder it is to find renters, and the harder it is to keep them.